Hey there, Brad Castro from GreatOptionTradingStrategies.com. In Casino Royale, the first Daniel Craig James Bond film, there's a great scene early in the movie where Bond is forced to chase an extremely agile and athletic bomb maker all over a Madagascar high-rise construction site and eventually into an embassy where things get even crazier. The bomb maker moves like water. He's fluid, a gymnast, athletic perfection. In contrast, Bond's style isn't that of a dancer but that of a bulldozer. But what he lacks in agility and grace, he more than makes up for with tenacity and single-minded focus. In the same way, when it comes to selling covered calls, there are two very different approaches or styles to navigating the stock market. Specifically, you can sell covered calls for income, or you can sell covered calls for total returns. And in this video, we'll explore these two very different approaches and why I think one of these ways is the best way to trade covered calls. And if you enjoyed today's video and anything resonates with you, be sure you're subscribed to the channel and that you're also subscribed to my free daily option trading tips and insights newsletter. Both the channel and the newsletter complement one another, as some topics are better suited in written form and some are better suited in video form. Both the channel and the newsletter are valuable option selling resources as we cover all aspects of covered calls and cash secured puts, from trade selection and setup to trade management to, most important, trade repair. You can sign up for the newsletter directly via the pinned comment below, or there's also a link in the description to the option trading downloadable library page on the Great Option Trading Strategies website. Download anything from there and you'll begin receiving the daily tips newsletter automatically. And if you want to periodically see some actual leverage investing club trades in real time for free, stick around till the end and I'll give you some more details about that. So let's start with selling covered calls for total returns, as this is how most covered call traders approach the strategy. Now, there's a lot to be said for this approach as it seemingly gives you the best of both worlds, capital appreciation plus income. The idea is pretty straightforward. Basically, you're selling out-of-the-money covered calls, meaning you own shares that are trading at such and such a price, or you buy them at such and such a price, and then sell a covered call at an out-of-the-money strike price, or at a strike price above where the stock is currently trading. You collect premium up front, and if the stock trades down, flat, or up a little, as long as it's not above the strike price of your covered call, that income is yours free and clear. The covered call eventually expires worthless, and you're then free to repeat the process. And if the stock makes a bigger move higher, the premium you collected from selling the covered call at the higher strike price is still yours to keep. But if nothing is done to manage or repair the trade, the shares will eventually be called away from you. But since you selected a strike price above the share price, you get to book the capital gains between that original share price and the covered call strike price. For example, let's say a stock is trading at $32.50 a share and you sell or write a $35 covered call expiring in 1 month for 50 cents a contract, or $50 before commissions and fees. If the stock is trading above $35 a share at expiration, you make $2.50 a share in capital gains plus the additional 50 cents a contract for having written the covered call, or $300 in total. And if the stock isn't trading above $35 at expiration, well, you've still at least pocketed that $50 in covered call premium and you're free to repeat the process. Brilliant, right? It's like having your cake and eating it too. Again, the idea is to generate returns that are a mix of capital appreciation and income. Farther out of the money you sell your covered calls, the less income you generate, but the more potential for capital appreciation you retain, and vice versa. If you sell your covered calls only a little out of the money, you'll bring in more premium, but the less upside in the stock that you'll participate in if the stock moves higher. Now, before we decide whether this is the superior way to sell covered calls, let's look at an alternative approach. Selling covered calls for income. Wait, isn't that what all covered call writing is done for income? Well, perhaps I should be more specific. Selling covered calls exclusively for income. And what you might ask is the difference. When you sell covered calls exclusively for income, you're giving up any claims to capital appreciation and simply isolating the income portion of the trade. And you do that by selecting a strike price below the purchase price of the shares. That sounds crazy, right? Now, this can sometimes take a while to wrap your head around, as selling in-the-money covered calls can seem counterintuitive. But the easiest way to really see what you're doing with an in-the-money covered call is to look at a different option selling strategy, and that's selling out-of-the-money cash secured puts. And that's very simple to understand. So let's go back to our $32.50 stock example. A cash secured put seller who sells puts for income and who, like the setup and payout, sells or writes a put at the $30 strike and collects 50 cents a contract or premium. The put seller does not own the shares. He or she is more like an insurance company insuring the shares, By writing the put at the $30 strike, there's a theoretical obligation to purchase the shares at that price should the stock be trading below that level at expiration. And guess what? An in-the-money covered call is essentially the same trade as an out-of-the-money short or naked put, as long as the strike price and expiration dates are the same. So the covered call writer could construct an equivalent trade by buying the shares at $32.50 a share and then selling a $30 covered call for $3 a contract. Both versions of the trade collect an equivalent amount of time value. Yes, there can be subtle pricing differences between calls and puts depending on whether an ex-dividend date is involved and depending on where short-term interest rates are. And on the surface, these trades may look very different from each other, but in terms of outcome and returns, they're basically the same. So let's walk through it. With our $32.50 stock example, where a put seller sells the $30 strike, if the stock is trading at expiration at or above $30 a share, the short put will expire worthless and the put seller books the 50 cents per contract of premium as the trade's final profits. And in that scenario for the covered call writer, the covered call will be automatically exercised and the covered call writer's 100 shares will be called away. There will be a capital loss of $2.50 a share because shares are purchased at $32.50 and sold at $30. But recall that the covered call writer collected $3 a contract up front. $2.50 of the premium was intrinsic value, or the difference between the share price and the strike price, and the other 50 cents a contract was extrinsic or time value. Presto, the final profits on both trades are the same, and they're both derived from time value sold. And the outcomes are also the same, in that both traders are now back in cash and do not own the shares. Now, what happens if the stock is trading below $30 a share at expiration and no adjustments or rolls or exits were done? Assuming the put seller does nothing, he or she will be assigned and forced to buy the shares for $30 a share. After factoring in the original 50 cents a contract of premium collected, the adjusted cost basis on those shares drop down to $29.50. And in that scenario, the covered call version, the covered call expires worthless. Covered call writer retains the purchase shares at $32.50, but after factoring in the original $3 a contract collected when setting up the trade, the adjusted cost basis on the shares drop to the same $29.50 level. A good way to think of it is that an out-of-the-money put and an in-the-money covered call are both structured so that their final profits will be comprised entirely of time value. Now, if you'd like to explore these dynamics at a deeper level, I've got a couple of other videos you might want to check out. In covered calls versus cash secured puts, I do a deep dive on how the two different strategies are actually 98% the same strategy, and I also go into more detail on how they're 2% different thanks to the dividend calendar and the interest rate environment. And depending on your personal situation, and assuming your number one priority with options is to sell them purely for income, it will make sense to primarily trade one or the other. And in the other video, Best Way to Sell Covered Calls for Income, I break down selling covered calls in the money, at or near the money, and out of the money, and explore the implications of each approach in terms of potential risk and reward. Okay, part 3, why I sell covered calls for income, not total returns. Now, I'm not going to tell you that the total return version is wrong or bad or that you shouldn't go that route. But I want to bring some clarity to the discussion and compare the total return and income variations more closely and show you why I think the income version is better than the total return version. Yes, the total return version of the trade has a much higher return potential, but that's not a function of the covered call. It's a function of the stock moving higher. In actuality, selling out of the money covered calls is a pretty aggressive trading strategy. Remember how we saw that selling an in-the-money covered call, or at a strike below where the stock is trading, is comparable to a conservative put seller selling an out-of-the-money put. Well, it works the same way with out-of-the-money covered calls. That's equivalent to a put seller selling an in-the-money put. With our previous $32.50 stock example, it would be equivalent to a put seller selling a $35 put. In other words, getting paid to insure or offer to buy that $32.50 stock for $35 a share. The same amount of time value is on the table in each version of the trade, but in order to actually hit the max potential gains, the stock must trade higher. But what happens if, gasp, the stock trades lower? This really is the crux of the issue, because selling covered calls for income gives you so much more downside protection compared to selling covered calls for total returns. Let's walk through our example again so it becomes crystal clear. With the income version, where you buy shares at $32.50 and then sell an in-the-money $30 covered call expiring in 1 month for $3 a contract, which again consists of $2.50 of intrinsic value and 50 cents of extrinsic or time value, your cost basis or break even is $29.50 a share. $32.50 a share less $3 a contracted premium equals $29.50. But with the total return version, where you paid $32.50 for the stock and only collected 50 cents a contract for selling the $35 covered call, your cost basis or break even would be $32 a share. $32.50 less 50 cents a contracted premium equals $32. Damn, that's a big difference in terms of downside buffer. Again, I'm not saying you're an idiot if you're selling out of the money covered calls rather than in the money covered calls. There may be perfectly valid and appropriate reasons why you might go with an out of the money covered call. If you have a long-term holding you don't want to lose, but you're trying to squeeze out a little extra income, or if that long-term holding is way overextended to the upside, or if it's already in pullback mode, then it can make sense to do some portfolio management and hedging and sell some out of the money covered calls. Or even if you're riding a growth stock in an uptrending channel and you see that you can bring in some extra income from selling out of the money covered calls that are outside that channel. But if you're just selling out of the money covered calls arbitrarily, be aware that you're working with a pretty flimsy safety net. And let's be clear, going with a more conservative income-only approach doesn't mean you're relegated to low returns. Inside the Leverage Investing Club, our core sleep at night strategy involves selling out of the money puts or in the money covered calls when we get specific setups we like. And since January 2025, or around the last 16 months or so, of the 63 official club trades we've closed, all of them winners, 92% of them have generated either double-digit or triple-digit annualized returns. Only about 8% of them have resulted in single-digit annualized returns. The key to our super high winning percentage, the ability to repair just about anything Mr. Market throws at us via our 4-stage trade repair formula. But this is important because we're starting in a more conservative spot, there are fewer repair situations, and when one does emerge, believe me, we're glad we started with a more conservative setup and strike price. If we routinely sold out of the money covered calls or in the money short puts, while we might make some serious bank on a few trades where the stock made a big move higher, there would be many more in repair mode. In repair mode longer, the returns on the repair trades would be considerably lower, and there would also be more trades where we would actually be forced to book a loss. And that's not sleep at night. Bottom line, selling covered calls for total returns is more aggressive. Yes, there's a potential for higher returns on individual trades, but that's not based on the premium from the covered calls. It's from capital gains and the stock doing all the work. With out of the money covered calls, there will also be more complications in trade repairs and more challenging trade repairs and even, heaven forbid, actual trading losses. In contrast, selling in the money covered calls is much more conservative with fewer complications, easier trade repairs, and as you can see with our trading history, you can still make damn good returns trading covered calls exclusively for income. Okay, if you enjoyed this and want more option selling resources, be sure to check out the channel's other videos and playlists and subscribe. The channel is really starting to gain traction and we recently blew through the 1,000 subscriber milestone. 2,000 subscribers, here we come. And I've also got a lot more option trading videos in the works. Also, as I mentioned at the outset of today's video, if you'd like to periodically see actual Leverage Investing Club trades in real time, not just after the fact, be sure you're signed up for my free daily option tips and insights newsletter, because recently I've started including daily tips readers on the occasional club trade. That includes sharing a PDF version of the trade idea right after I put it together and post it inside the Leverage Investing Club. I call these Leverage Investing Club open house trades, and it's a great way for non-club members to get a glimpse into the Leverage Investing Club, our trading approach, and to see firsthand how effective and profitable that approach can be. And in addition to the original trade idea, usually posted over a weekend, I also include daily tips readers when I send out real-time trade alerts, which I do anytime I enter a trade, roll or adjust a trade, or exit the trade. And then the fun part. After the trade has been closed, I put together a full case study that includes the original write-up, all the trading activity, any commentary I added along the way, and a breakdown of what I feel are the most important lessons or insights the trade has to teach or reinforce in us. To date, we've successfully concluded one open house trade, and we also have another one that's still open. And the one that we closed was a really lovely trade on T. Rowe Price, even though it did misbehave a little bit. But still, we walked away with a very nice 20.06% annualized ROI over 65 days, which I've compared to investing in a 2-month CD with an APY of 20%. Now, obviously, these trades aren't FDIC insured or anything like that, but I would point out that it's extremely rare that we ever book a loss. Again, primarily because of our highly effective trade management and repair process, which is based on the magic of basic math, and a healthy disrespect for crowd psychology. In any case, I've added a couple of open house trade links below for you to check out. One is a link to download the 12-page case study on that T-Row open house trade, as well as a video that breaks down the T-Row trade and the entire open house trade process. Okay, until next time. And remember, heads we win, tails Mr. Market loses. That's our mantra and reality inside the Leveraged Investing Club, and it can be yours too.